I want to bring in Michael Purvis, the chief global strategist at Weeden, who says despite the recent volatility, the market is not broken and the recent pullback sets the path for a move higher in stocks. But Michael, how can you say that, though, when just even one case here in New York City gets people scared and start selling their stocks?
Well, if you look at how the market's responded over the last week or so, since we had the height of that volatility and the lows in the stock market, the markets had sort of V'd back very aggressively. So even without an Ebola scare, we were due for a little bit of consolidation here, right? So to me, markets have rolled off a little bit overnight and into this morning. But to me, that's sort of a normal sign of a recovery. And sure, there's, Ebola does have to be considered here, in terms of what it could have a broader impact. But let's face it, at this point, it is starting to be aggressively managed here, and it's
finally, right? It seems like we're finally waking up and tackling this.
Well, it seems like the Ebola headlines, when they come out, tend to have a little bit of an effect on the market, but they have over the past several weeks when we've seen more volatility, to your point. It's more like if we're in a delicate place in the market already, then we see a bigger pullback on something like Ebola headlines or whatever headlines we've been seeing from around the globe.
But so if you had this headline, say, a month ago when markets, or on September 19th, when markets were pushing into new highs, sentiment was starting to get into the froth levels, then that would be maybe a catalyst for a broader rollover here. Right now, if you look at equity sentiment levels, they have contracted to 12-month lows here on bullish sentiment readings. So to my mind, it's all about the broader context for when these headlines hit. So, sure, it knocks us off 30, 40 bips or so, but to my mind, that's sort of a normal course of business and not an indication that something's broken.
I wonder how much you take your lead from other asset classes, like credit markets, for instance. We have a chart that shows the relationship between the credit market and the stock market, and what you see is that credit tends to lead equities. Credit peaked in June, equities peaked in July and made another run in September, and once again, on to the downside, credit leads the way. How much are you looking for credit to give indication of the shift in sentiment on the global economy?
All the time, absolutely. It's very critical. The bond markets don't always lead equities here, but they frequently do. One metric that I've been looking at a lot is the MOVE index, which measures Treasury volatility, and that had been sort of grinding into sort of lifetime lows during the first half of the year, and it started making higher lows back in July, and I think that combined with some of the currency volatility was what helped create move the VIX into that higher range.
What do you think then about all these concerns about a liquidity crunch in the credit markets?
Well, you're talking about the big, when you have these jarring moves.
Yeah, the inability to get out.
Right. You see, and that I think is one of the things that really defined this October volatility. And one of the things that I've been trying to express is that just because you've had these jarring moves, because some of the shock absorbers from the big banks are not in there making the markets like they used to, that doesn't mean anything's broken. It means the path by which securities move may be a different path. But are the economics fundamentally different? Not necessarily. Now, it is something that I think we all have to be cognizant of here, because the abruptness of these moves was very, very sharp. But for example, if you looked at the VIX, okay, we peaked at 30. That's not really that unusual. It was the abruptness going to 30.
The rate of change.
Right, exactly.
So we spoke with Mohamed El-Erian yesterday, and we were talking about what are the big lessons that he learned from last week's selling, right? So, Michael, let me play for you part of his description on what he learned about the markets.
Realized volatility is back. Why? Because the foundation of the market is weak. The fundamentals aren't strong enough to support this level of prices. Why did we sell off yesterday? Really on a rumor that Chinese growth would be much lower, that the PMI would be bad. So it tells you that this is still a tentative market and we need better
fundamentals. Very easily dislocated, this
One way or the other. One way or the other.
So as you say, there aren't those shock absorbers anymore, right? And the economy is not strong enough yet.
Well, there's different types of shock absorbers. I was addressing the liquidity issues, for example. But I think the biggest new question...
The economy's not strong enough, let's say, as a shock absorber for these types of rumors.
The biggest question in my mind, certainly, the China factor, Mohammed's completely right, that is something that is, it is a huge issue going forwards. But the Chinese do tend to address these issues pretty aggressively, and they have the means to address these issues most of the time, right? They still have $3 trillion in FX. The big question, for my mind, in October was the Eurozone, because you had these deflationary scares coming in that were pretty nasty. The big question was, really, can the ECB, does it have the will and does it have the way to do it? And both of those were, Mario Draghi certainly articulated the will, but the path to it was very uncertain. But what have we seen since the volatility spiked? We've seen them come in and buy assets, pretty much every day over the last several sessions there. So, and there does seem to be, the ability to actually continue to do this. And I think that's really important. That question got answered, I think, pretty aggressively.
All right, Michael, thanks so much for joining us on this Friday morning. Michael Purvis, the Chief Global Strategist at Weeden.